Professional status is often worn like armor in the markets, a polished belief that decades of screen time, institutional credentials, and sophisticated analytical frameworks confer immunity from manipulation. This illusion crumbles under scrutiny. Richard Wyckoff, through relentless observation of tape action and the market's hidden mechanics, shattered this myth a century ago. He witnessed the same orchestrated conditions, provoking identical reactions regardless of the participant's resume, bankroll, or institutional backing. The difference between professional and amateur losses lies not in susceptibility but in scale, where institutional failures cascade through larger positions and career-defining consequences. Wyckoff identified the market's true nature as a systematic battlefield where one side possesses decisive advantages. He termed this coordinating intelligence the composite man, representing the collective actions of smart money that understands successful campaigns require fuel in the form of liquidity harvested from predictable human responses. This entity does not hunt randomly. It targets standardized behavior patterns, whether they emerge from retail emotion or institutional policy compliance. 7 specific traps operate with mechanical precision across all market conditions, each designed to exploit common analytical blind spots and psychological vulnerabilities. The effort-result blindness trap exploits the professional tendency to interpret volume mechanically without measuring outcome against energy expended. Record participation, accompanying minimal price progress signals distribution. Yet sophisticated systems generate signals based purely on activity metrics without weighing the crucial relationship between effort and result. The cause-neglect trap ensnares those who chase momentum without verifying sufficient preparatory work. Advanced algorithms excel at pattern recognition but remain blind to the underlying cause and effect relationships that determine campaign sustainability. The liquidity honeypot trap engineers false signals through springs below support and upthrusts above resistance, transforming apparent breakouts into collection mechanisms for protective stops and wrong-way participation. Danger point inversion follows inevitably, as institutional risk management places protective orders at textbook levels, where the composite man expects to find them, rather than beyond successful test points where risk becomes minimal. Phase misreading compounds these errors when increased volume without price progress during late markup signals distribution. Yet momentum frameworks interpret this as accumulation. Volume deception completes the technical snare, where climactic prints at extremes confess exhaustion rather than confirming strength. Beneath every technical error sits the most human vulnerability, the hope-driven hold trap. Here, rules bend under pressure, stops widen beyond logic, and reputational risk whispers that patience equals prudence. Professional discipline dissolves as hope finances positions against predetermined levels, transforming systematic traders into liquidity sources for smart money campaigns. These traps transcend experience because they exploit fundamental aspects of human psychology that remain constant regardless of professional development. The composite man engineers specific conditions triggering hope, fear, greed, and ego in precise sequences that facilitate systematic liquidity extraction from those who mistake complexity for wisdom. Recognition of these vulnerabilities marks the beginning of market education rather than its completion. If you recognize yourself caught in these patterns, comment with the word trapped, and begin the journey from reactive participation to disciplined operation. Wyckoff's counsel remains timelessly relevant. Argue with the tape and the tape will invoice you, but read the campaign with structural clarity and trade evidence rather than hope. Wyckoff's law of effort versus result provides the first uncompromising lens through which market action becomes legible, transforming charts from decorative patterns into evidence of underlying intentions. This law operates with mathematical precision, demanding that every price movement be judged not by its motion alone, but by the energy required to produce that motion. Effort represents the volume signature, the raw expenditure of capital and conviction, measured through participation and activity. Result represents the net progress, the distance traveled after all. Cross-currents subtract their influence, measured through actual price advancement and directional achievement. The relationship between these two components reveals the market's true power dynamics with diagnostic clarity. When effort expands and result contracts, something is resisting the movement, typically indicating distribution near highs or absorption near lows. When effort contracts and result expands, something has yielded, suggesting that opposition has been neutralized and the path of least resistance has been established. The composite man reveals his hand most clearly at these boundary conditions where effort and result diverge, where appearances mislead and campaigns quietly change ownership. Consider the breakout that arrives on record participation, yet advances only a few points before stalling and closing off the highs. The tape looks strong to those who count transactions but ignore progress. Yet this divergence confesses distribution in progress. Smart money is systematically transferring position to willing buyers, using promotional activity to mask methodical selling. Record volume without corresponding price advancement reveals the composite man completing position transfer while maintaining price support through calculated intervention. Conversely, after substantial declines when a modest burst of demand lifts price cleanly through minor resistances with surprisingly little volume, the market is light because supply has been absorbed and small effort delivers outsized result. The first professional trap springs from this diagnostic blindness. The effort-result blindness trap exploits the professional tendency to interpret volume mechanically without measuring outcome against energy expended. Sophisticated systems reward participation metrics, flag liquidity as strength, and codify the belief that more volume equals more validity. Yet markets are not town halls where votes determine truth. They are auctions where the marginal trade tests the capacity of the order book. Institutional algorithms excel at identifying volume spikes and trigger buy signals when activity exceeds moving averages or percentile thresholds, completely ignoring whether that expenditure produced proportional price advancement. Professional trading systems generate signals based purely on participation metrics, missing the crucial relationship between activity and achievement. The trap springs when teams conditioned by dashboards and overlays authenticate the very prints that reveal their counterparty's distribution plan. Heavy volume accompanying narrow price ranges near market highs becomes a buy signal rather than a distribution warning, transforming sophisticated professionals into willing recipients of transferred inventory at precisely the wrong moment. The second trap operates through temporal blindness, exploiting momentum-driven decision-making without structural verification. The cause neglect trap catches traders who chase moves without measuring whether adequate cause has been built to sustain the anticipated effect. Wyckoff taught that accumulation and distribution are construction phases, slow negotiations where the composite man builds inventory or disposes of it within ranges that seem purposeless to the impatient eye. These trading ranges are not merely periods of indecision or latency. They are strategic construction zones, where systematic preparation occurs through carefully orchestrated price action, designed to appear random or technical. Cause represents time plus volume plus volatility compression within these ranges, where tests confirm absorption and opposition is systematically neutralized. Effect represents the subsequent directional campaign, whose length and vigor correspond directly to the preparatory groundwork. Professional momentum systems generate signals based on pattern completion or technical breakouts, assuming that formation recognition equals campaign validation. This approach ignores the fundamental requirement that cause must precede effect in proportional measure. Without sufficient cause, the spring lacks fuel, and the upthrust finds sellers waiting. With adequate cause, a single bar can travel a day's distance because opposition has already been neutralized through the preparatory work. A narrow trading range cannot support a sustained directional move, regardless of the breakout's technical appearance, while an extensive accumulation or distribution phase creates sufficient cause for major campaigns. Professionals driven by performance windows and benchmark pressure often treat these ranges as delays rather than architecture, entering late-stage breakouts that lack sufficient backing, and then attributing failures to market volatility rather than structural inadequacy. Volume signatures during these preparatory phases reveal the composite man's intentions to those who understand the effort-result relationship. Absorption on declines with narrow spreads indicates accumulation in progress, while promotional activity on advances without corresponding progress signals distribution. Heavy churn with minimal net progress suggests selling into strength near highs, while quiet pullbacks that hold key levels often represent lack of supply rather than lack of interest. Effort-result analysis sharpens execution across multiple timeframes with surgical precision. On the higher timeframe, it answers whether a campaign is structurally feasible. On the intermediate time frame, it reveals whether a breakout is sponsored or opposed. On the execution time frame, It identifies the moment when a test succeeds and risk compresses at the danger point. The same law explains why climactic energy at extremes often marks transfer rather than continuation, transforming apparent strength into diagnostic weakness and apparent weakness into accumulation opportunity. The discipline demanded here is simple to state and difficult to practice consistently. Every significant price movement must be interrogated with the same diagnostic question. How much did the market spend to get here? And how far did that expenditure carry it? The answer confers intellectual safety because it anchors decisions in observable relationships rather than interpretive hope. This law-based approach requires patience and structural thinking that conflicts with conventional momentum strategies. Yet it transforms the professional from reactive pattern follower to proactive structural analyst in reading campaigns before they announce themselves through obvious technical signals. If this diagnostic relationship clarifies the difference between promotional activity and genuine accumulation, comment with the word effort as a reminder that volume without progress is not strength, and progress without volume is not weakness, but information that reveals the composite man's true intentions. Market structure speaks in phases rather than isolated bars, transforming scattered motion into coherent campaign architecture that reveals the composite man's systematic approach to liquidity harvesting. These phases unfold with mechanical precision, each serving distinct strategic purposes in the larger campaign. Phase A establishes stopping action, where preliminary support or resistance interrupts the previous trend, creating the first evidence that organized opposition has emerged. Phase B represents the crucial cause-building period, where systematic testing and absorption occur within trading ranges that appear purposeless to impatient observers, but actually constitute construction zones, where the composite man builds or distributes position through carefully orchestrated price action. Phase C delivers the decisive moment through springs below established support or upthrusts above visible resistance, where the campaign's true direction receives final validation or reveals its deceptive nature. Phase D marks commitment as early markup or markdown begins with positioning secured, while Phase E brings public participation as trends become obvious and late entrants provide exit liquidity. This rhythmic progression from stopping action through cause building to decisive testing creates the structural foundation that the most sophisticated traps exploit. The liquidity honeypot operates with surgical precision during Phase C, engineering false signals that mimic legitimate breakouts to professional pattern recognition systems. Springs beneath established support levels trigger protective stops and automated sell signals, creating precisely the conditions the composite man requires for final accumulation at advantageous prices. Upthrusts above resistance activate buy algorithms and momentum signals, providing distribution opportunities as late participants enter exactly where smart money seeks exit liquidity. Professional systems excel at identifying these apparent breakouts but fail to distinguish between genuine campaign launches and engineered liquidity raids designed to harvest predictable responses. The crucial difference emerges through the successful test that follows authentic movements or exposes deceptive ones. True breakouts maintain their ground and build upon initial progress, while liquidity raids quickly reverse as their harvesting purpose concludes. Volume signatures during these tests reveal intentions to those who understand effort-result relationships. A spring that holds on contracted volume with demand reasserting confesses accumulation completion, while an upthrust that fails on lack of follow-through admits distribution exhaustion. Danger point inversion compounds this vulnerability through systematic stop placement at obvious technical levels rather than beyond validated test points. Professional risk management positions protective orders precisely where textbook analysis suggests they belong, creating concentrated liquidity pools where the composite man expects to find them. The true danger point emerges only after successful tests confirm campaign direction, transforming risk from arbitrary percentage calculations to precise measurements from validated levels where opposition has been definitively neutralized. This mechanical understanding reframes risk-reward calculations from obvious swing points to confirmation levels, requiring patience for validation before commitment. When springs hold on retests and demand reasserts, risk compresses to the distance beneath that successful test, rather than the entire range depth. When uptrusts fail on lack of sponsorship and supply returns, the danger point sits just above the test high where the deception concludes. Precision comes from allowing the market to declare its true intentions through these decisive tests. then aligning capital where asymmetric opportunity emerges from the composite man's completed preparation. Wyckoff's law of cause and effect transforms trading ranges from periods of uncertainty into quantifiable reservoirs of campaign potential, where the scope and duration of subsequent moves become measurable through structural analysis rather than speculative hope. Cause represents the accumulated work performed within these ranges, measured through time spent, volume transacted, and volatility compressed during systematic building or distribution processes. Effect represents the directional movement, whose magnitude corresponds directly to this preparatory groundwork, creating a mathematical relationship where extensive ranges with substantial turnover generate proportionally greater potential for sustained campaigns. The phase misreading trap exploits professional tendency to confuse accumulation signatures with distribution patterns during critical transitional periods. Near the end of markup phases, swelling volume without decisive price advancement confesses distribution in progress as the composite man transfers position to willing buyers. Yet momentum-trained systems interpret this activity as institutional accumulation, confirming trend continuation. The surface texture of increased participation seduces analysis away from structural reality, where promotional selling masquerades as buying interest. Conversely, during genuine accumulation phases, quiet absorption on declines with narrow spreads appears as weakness to conventional volume analysis, causing professionals to miss the building cause that creates substantial campaign potential. Volume deception amplifies these errors at market extremes, where conventional interpretation reverses actual meaning. Climactic volume at market highs, rather than confirming strength through participation metrics, often signals distribution culmination as the composite man completes position transfer to emotional buyers attracted by apparent momentum. What appears conclusive is often terminal. Selling climaxes with wide spreads and panic volume frequently mark accumulation zones where systematic buyers absorb desperate sellers, yet professionals mistake these signatures for breakdown confirmation rather than supply exhaustion. Multi-timeframe integration restores precision to this reading, where higher timeframes define campaign direction and effect potential. Intermediate timeframes locate danger points where risk compresses after successful tests, and execution timeframes offer precise entries when effort and result align. Professional systems operating on single timeframe signals fragment this structural story, making them vulnerable to deceptive signals the composite man strategically employs. The discipline required here transforms isolated price movements into coherent supply-demand narratives, where campaign potential becomes quantifiable through observable preparation rather than interpretive speculation. The most dangerous failure in professional trading emerges not from ignorance of method but from emotional override at precisely the moment when method must be obeyed without negotiation. The hope-driven hold trap operates with surgical precision when positions slip beneath predetermined levels, transforming disciplined professionals into willing liquidity sources as the mind quietly reframes risk as patience and recasts mechanical rules as discretionary suggestions. This psychological vulnerability transcends technical sophistication, exploiting fundamental aspects of human cognition that remain constant, regardless of analytical credentials or institutional backing. Wyckoff's timeless observation that hope is ruin finds its modern expression in committee rooms and risk dashboards where quarterly performance pressure, benchmark proximity, and mandate compliance create systematic incentives for rule violation. Professional traders, having invested intellectual capital and reputational equity in their analysis, often finance losing positions, while hope masquerades as strategic conviction. The trap becomes particularly insidious during distribution phases where the composite man maintains price support just long enough to encourage position averaging and stop-loss cancellation, letting sequences of small supportive prints whisper that recovery approaches while inventory systematically transfers to those who mistake engineered buoyancy for genuine demand. Career risk amplifies every psychological vulnerability, transforming mechanical exits into discretionary holds when mandate tracking requirements override individual position discipline. The institutional trader faces a double bind where cutting losses threatens quarterly numbers, while holding losers threatens systematic ruin, creating precisely the emotional conditions the composite man exploits through calculated price manipulation that appears supportive enough to justify delay. 4 psychological archetypes operationalize these emotional overrides across all 7 traps with predictable precision. Hope causes averaging into distribution phases and refusing to honor spring failures when tests clearly demonstrate campaign exhaustion. Fear creates premature exits during successful accumulation tests and profit-taking at the moment when asymmetric opportunity emerges from compressed risk. Greed drives participation in obvious uptrusts and over-leveraging when promotional activity appears strongest, while ego refuses to acknowledge contrary evidence and argues with clear tape signals that contradict established positions. These emotions ride on cognitive biases that professional credentials cannot erase. Loss aversion prevents cutting losses even when evidence clearly demonstrates campaign failure, anchoring decisions to past entries rather than current reality. Recency bias magnifies the latest price action into destiny, overweighting immediate signals while forgetting structural context. Confirmation bias harvests only supportive data from crowded screens, cherry-picking evidence that validates existing positions while ignoring contradictory signals. The illusion of control mistakes activity for skill, encouraging position management rather than position elimination when campaigns clearly reverse direction. The antidote requires not stronger opinions but colder processes that remove discretionary judgment from moments of maximum emotional stress. Pre-commitment through written protocols, explicit danger points defined by successful tests, and rehearsed abort criteria transform trading from reactive decision-making into disciplined operation. Mechanical execution systems that specify responses to defined conditions encounter the composite man's psychological manipulation with prepared responses rather than vulnerable emotions. Checklists forcing effort result appraisal before entry, and time-based exit rules that dissolve stale campaigns reassert discipline when cognition narrows under pressure. This mechanical approach demands intellectual humility, acknowledging that superior analysis means nothing without superior execution discipline. Edge emerges when decisions are made in the calm before the trade, not in the adrenaline after price moves against predetermined levels. The professional who argues with the tape will find the tape invoices them with mathematical precision, while those who read campaigns with structural clarity and trade evidence rather than hope discover that the composite man's systematic approach can be matched with equally systematic discipline. Recognition of these 7 systematic vulnerabilities marks the threshold between market participation and market mastery, where the professional trader transforms from unwitting liquidity source into disciplined campaign reader. This transformation requires more than intellectual understanding. It demands the cultivation of a trading ethic that operates through structural principles rather than emotional impulses. Mastery emerges not as a collection of techniques but as a disciplined way of seeing that refuses to be hurried by promotional activity, flattered by apparent breakouts, or frightened by engineered volatility. Each trap dissolves when reframed as a systematic consequence of ignoring Wyckoff's foundational principles. Effort result. Blindness vanishes when every decision weighs outcome against energy expended, refusing to authenticate volume without proportional price progress. Cause. Neglect disappears when sufficient preparation becomes the prerequisite for campaign participation, demanding visible accumulation or distribution before committing capital. Liquidity honeypots lose their power when confirmation follows apparent breakouts, distinguishing genuine commitment from engineered raids designed to harvest predictable responses. Danger point inversion transforms into precision when protective stops anchor beyond successful tests, rather than obvious technical levels, compressing risk to minimal distances where asymmetric opportunity emerges. Phase misreading yields to structural analysis that reads supply and demand narratives rather than naming decorative patterns, understanding that increased volume without progress confesses distribution, while quiet absorption reveals accumulation. Volume deception evaporates when climactic prints are contextualized within campaign architecture, recognizing exhaustion signatures where conventional analysis sees confirmation. The hope-driven hold dissolves through pre-commitment to mechanical execution, where rules operate regardless of emotional comfort or career pressure. This integrated approach rests upon 3 foundational pillars that support consistent performance across varying market conditions. Structural analysis supersedes pattern recognition by anchoring decisions in observable cause and effect relationships, where trading ranges become construction zones rather than periods of indecision. Patience overcomes urgency through understanding that markets reward those who wait for validated signals, rather than chase symmetrical action, recognizing that the composite man's timeline operates independently of performance windows or benchmark pressure. Logic dominates emotion by demanding that every position justify its existence through current evidence rather than past reasoning, where hope becomes a measurable liability rather than strategic virtue. The discipline required transforms from restrictive burden into operational advantage through systematic practice that builds neural pathways for correct responses under pressure. Daily chart annotation by phase identification reveals campaign architecture invisible to momentum-focused analysis, while marking effort result divergences exposes accumulation and distribution signatures that conventional volume metrics miss entirely. Identifying true danger points beyond successful tests, rather than textbook levels, creates precise risk measurements, where edge becomes quantifiable. Rehearsing mechanical responses to common scenarios prepares the mind to execute disciplined decisions when cognitive capacity narrows under emotional stress. This methodical approach cultivates professional calm that operates through evidence rather than opinion, where the composite man's systematic campaigns become readable blueprints rather than mysterious forces. Apparent market randomness resolves into coherent supply-demand narratives when viewed through structural analysis, where every significant move reveals its preparatory cause to those trained in Wyckoff methodology. The tape stops arguing with the trader and starts confessing its intentions to those who understand that volume without progress reveals distribution. Progress without volume indicates absorption, and climactic action at extremes often signals exhaustion rather than continuation. Success emerges when the practitioner abandons predictive ambition in favor of responsive precision, understanding that edge comes from reading what is rather than forecasting what might be. The market rewards alignment with its underlying forces rather than opposition to its surface movements, where discipline becomes synonymous with timing and patience, transforms into strategic positioning. Those who master these 7 traps discover that trading excellence requires not superior prediction but superior preparation, not emotional courage but systematic discipline, not fighting the market but reading its campaigns with the same methodical approach the composite man employs to engineer them. The journey from trapped professional to disciplined operator demands acknowledging that sophisticated tools mean nothing without sophisticated execution, where intellectual understanding must mature into operational reflex through consistent practice and mechanical adherence to validated principles. This mastery reveals itself not through dramatic profits but through systematic consistency, where each decision flows from structural evidence rather than interpretive hope, and where the practitioner joins the small percentage who understand that successful trading is ultimately about being disciplined rather than being right. If this framework clarifies the path from vulnerability to mastery, share the single word naming the trap that has extracted the highest tuition from your trading account, beginning the community dialogue that transforms individual lessons into collective wisdom.